comes to the Nifty. It is now nearing that 26,000 mark. But to understand what the fundamental market setup is looking like, we are now joined by Rupen Rajguru, Head of Equity, Investment and Strategy at Julius Baer, now joining us. Mr. Rajguru, afternoon, and thank you so much for joining us here on ET Now. And first up, your thoughts on the current market setup. Nifty is at a fresh record high, but broader markets are still underperforming. Nifty small cap index, for instance, is still down 11% from its record high. What kind of strategy would you recommend in this kind of a market setup? Is it best to keep some powder dry, and do you expect market to consolidate at least in the short term?
Yeah, hi. Good afternoon. So, in fact, as you rightly said, if we just zoom out and look through, Indian markets has seen a reasonably good amount of consolidation. So practically, we are at the same level at which we were probably in September of 2024 at a Nifty level, and we are much lower on the mid cap and small cap level. So, and if I were to add to it a global layer, we have been a significant underperformer. And one of the key reasons for this underperformance and consolidation has been the earnings growth, has been anemic for now 6 quarters in a row. Having said that, basis the steps taken by the government and by the Reserve Bank of India, we clearly believe that the earnings growth trajectory is going to change. So just to give you perspective, the earnings growth for last financial year for Nifty was around 5-6%. This year we will probably end at 7-8%. But we believe that from FY27 onwards, the earnings growth will be in double digit. We are expecting more than 15% plus in 27. So the earnings growth trajectory is going to go higher. So with that perspective, what we believe that this is the time to add into the Indian equities market, and this we have seen a good consolidation phase and time to add equity in the client's portfolio. That's our view.
Okay, Mr. Rajguru, point taken, and thanks for putting that into context. But as you say that now would be a good time to dip your toes into the market and start making fresh allocations, where would those good sectors or good places be? Some good avenues where investors should start, accumulating for the near to medium term.
Sure. Yeah. Hi. Good afternoon. We have to look through that. Which are the sectors where the earnings growth will be higher? So one sector which clearly stands out, are banking and financials. So as a sector, we believe that the earnings growth will be pretty strong for next 1 year or so. And within banks, while large cap banks will do well, but mid-tier banks we believe will outperform in this market. So that's the one segment. The second segment where clearly the focus of government has been is consumption. So be it the measures which the government has taken by way of a tax cut, both on the direct side as well as on the indirect, that is GST front. So more money will be in the hands of the consumers, as well as the stimulus given by the RBI by way of rate cuts, which is monetary stimulus, which also means that you have to pay lower for your EMIs. So consumption as a basket, we believe, will do well. And tactically, in the near term, the rural consumption will do well. But overall, structurally, we are positive on discretionary consumption. So that is the second basket, which we believe can do well over next couple of years. And finally, as a theme, what we like here is these sectors which has already witnessed consolidation and the overall competitive intensity has gone lower. So be it aviation, be it telecom, be it cement, these are some of the segments which at a overall thematic level we like, because that sector has seen a reasonably good amount of consolidation. So these are few themes and few sectors which we like from a medium to longer term perspective.
Okay, and any sector that you're completely avoiding at this point in time, either because the valuations are expensive or you expect the growth probably to slow down going forward?
As such, if you see, as I said, we have seen a reasonably good amount of time correction across sectors. Always there will be bouts of within sectors there can always be stocks which one can avoid because probably it's baking in too much of a high amount of growth in that. But as a sector per se, but no, I would say some of the sectors which probably would be quoting at a very high valuations, wherein a lot of growth is baked into it. So some amount of say no, EMS and all, probably we would wait for better entry price. So it's not that we don't like that sector, but say some of the capital market intermediaries, EMS, we will wait for better entry points to get into that. So we like that sector, but probably not that comfortable with the current valuation at which they are trading.
Okay, and what about the tailwinds or the positives that we were supposed to see from the GST cuts in overall consumption, discretionary consumption, autos? Do you think that has played out? Have we seen that impact in the numbers that we've seen so far, or do you believe that there is more headroom over there?
So see, auto as a sector, if you look through, probably it had I would say, a lost decade. There were a lot of changes on the regulatory side, wherein the way things should be there in an automobile. Plus, we were hit by COVID, so for a long period of time, the overall auto volumes was much more than the GDP growth. With the current impetus, which we believe it's just a starting point of a new cycle in automobiles. So it's not that it's just a one quarter phenomena that okay, GST cut has happened and we had just all this pent up demand which is met. We are structurally positive on automobiles from next 2 to 3 years perspective. We believe the volume growth will be much better for next 2 3 years as compared to what it has been for past 5 years or so. And probably in our pecking order, we would prefer passenger vehicles more. In two-wheelers, we like companies which are into ahead in the game of the electrification side on the EV side. And in fact, frankly, even we are seeing an upturn in the MHCV cycle. 'Cause some of the numbers which came out by leading players out there has been pretty encouraging, and we believe that also starting of a cycle. So all in all, automobiles, we are positive on that. And while from a stock market perspective, always market is much ahead. Some little bit of good news is already discounted, but from a business standpoint, we believe that the business has enough legs to grow higher from where it is right now for at least next 2 to 3 years.
Okay, so that's as far as the auto sector is concerned, but also wanted your thoughts on the primary market action. We've seen a lot of IPOs of late. Have you participated in any of those? And we also have the big Meesho IPO, which will open for subscription tomorrow. Have you looked at the financials and your thoughts on the primary market action?
Yeah, I would refrain from commenting on a particular stock, but in primary markets, I would say it's a good, a healthy sign, which is what we are seeing. While yes, valuations of some of these companies which are coming public probably are not leaving it on the table, but I think what's clearly happening is that in India we are seeing a lot of new age companies now getting listed. So probably few years back there were hardly any couple of companies which are listed, but now many new themes, new age companies, themes from the solar side, from the platform companies, more and more companies are getting listed, which clearly will improve the overall depth of the market. And from an overall uh, you know uh, PE standpoint, because a lot of PEs are exiting or monetizing via the IPO, so which I think is a good, it is creating a good loop, because once a lot of the PEs are seeing that they are getting a good exit in India, which probably from a future money perspective, I think they'll be much more confident in investing money into India because they are seeing that getting monetized. So overall, while some of the valuations of the IPOs, one might kind of have a question mark around that, but whatever is happening, we believe while it is sucking some amount of liquidity, but it is good from a long term health of the capital markets of the country.
Okay. And Mr. Rajguru, where do you think the policy outcome is going to tilt on Friday when we have the MPC outcome coming in, given that we've seen mixed set of numbers? On one hand, GDP has been very strong. On the other hand, yesterday, IIP numbers have been very weak. What do you think could happen, and what could the implication be on financiers and NBFCs in particular?
So look from a no market no rate cut perspective. As you rightly said, with a very strong GDP print and all, the possibility of a rate cut probably might no be pushed back and might not happen in this quarter and might happen subsequently in February or so. So overall, we expect around 25 odd basis point cut.
All right, apologies for interrupting you there, but let's go across clarification coming in on the Sanchar Sathi app that it can be deleted and it is not mandatory. That's some important clarification that has come in from the minister. But Mr. Rajguru, apologies for cutting you there and thank you for staying on with us. Please complete the point that you were making.
Yeah. So from a banking and NBFC perspective, if you see, we clearly believe that NIMs have bottomed. Even if there were to be one rate cut, we don't see a significant impact on the NIMs. And in fact, they have held on pretty good in the ensuing quarterly earnings which went by. From that perspective, net, just to conclude here, we are entering into a cycle in which probably the growth will be much faster. In fact, the largest bank is talking about credit growth of anywhere between 12 to 14%. So definitely some of the NBFCs and all the growth will be much higher than that. So in a scenario in which there is the credit costs are overall lower, and the NIM compression also is not going to be pretty high. So no, the banks and NBFCs which will have higher credit growth will outperform in the current market scenario. So that is our take on that segment.
Okay, on that note, Mr. Rajguru, we'll let you go. Thank you so much for your time. And once again, thank you so much for staying on with us while we cut out to the parliament. But on that note, we'll slip into a very short break and be right back on the other side to talk more about markets.